Hello, and welcome to another episode of the Wealth Building Strategies Podcast. I'm your host, Jeremy Constantino. And today I'm more than pleased to bring on as a guest Mr. David Robinson. Welcome, David.
Well, thank you very much for the invite. I'm excited to be on your show, Jeremy.
Excellent. So, David is a expert, so to speak, in syndication and real estate, even real estate brokerage. So, David Robinson is CEO and founder of Canovo Capital. Is that how you pronounce it?
Yeah, Canovo.
Canovo Capital. He's an active investor, broker, and podcast host. He's a creator and host of the Lead Sponsor podcast. Which, how many episodes have you already done?
I think we're about 220 or so episodes in at this point.
That's impressive. And he has been directly involved in over $350 million in real estate transactions. So again, welcome, David, and thanks for coming on the show.
Yeah, my pleasure.
So, like you and I were talking before the show, the majority of our listeners to this podcast is our real estate investors who are just starting out in real estate investing. And also we have a large following of real estate brokers and realtors. So I guess let's just jump right into how did you get involved in real estate syndication, I guess. So I guess kind of tell your story of maybe even before that, how'd you get into real estate and then what led you into real estate syndication?
Well, I'm glad that we've got real estate brokers and realtors, listening to the show because that's my background. I spent the last 18 years or so in the real estate business. The vast majority of the front end of that time as a agent myself, and really focused on the residential resale, a typical residential brokerage business. I was managing sales teams and a national franchise brokerage. I cut my teeth in the short sale world. I got into the business in 2003, 2004, ramped up, and then built out a pretty substantial short sale foreclosure prevention business that focused on helping folks that were in tough times during the recession.
So did you start out in a nationwide national brokerage company?
No, boutique firm when I very first started, then opened my own small brokerage, transitioned to a larger franchise, nationwide franchise, where I managed my small sales team and also one of the franchises here locally in Utah.
And so that was all predominantly residential sales
Yeah,
at the
yeah.
beginning.
Almost exclusively residential sales, trickle in a few, random commercial transactions here and there. And for the most part, I was, early on, I was definitely selling, houses, but mainly through the short sale business. And then, as my career sort of evolved, I was mainly on the management side, running a sales team and managing it. And so I totally get the business of selling real estate as a real estate agent and a real estate broker. And that was really, why I transitioned into the other side of the business. Unfortunately, after a decade of being in the real estate space, I had done very little investing on my own side.
That was going
And
to be my
it's
question.
unfortunate. I'm sure that there's a lot of listeners, if they're a broker or an agent, who this may resonate with. Unfortunately, all too often, there's too many real estate agents and brokers that have been in the business and failed to do their own real estate investing and building up any substantial amount of cash flow or wealth in their life. And that was me. And I had a moment in time where a life incident where my dad really got sick after a heart surgery, went septic, and virtually died. They were able to revive him, and he's still with us today. But that moment in time made me really think about what I had accomplished over the last decade of being in the real estate business. And I hadn't done nearly enough to really feel like I had done what I was setting out to do. And so that was the reason for me leaving the residential business almost exclusively and transitioning to the investment side of the world. And so that's when I started my own boutique small brokerage with an emphasis on serving investor clients, particularly investors, buy and hold investors who were looking to acquire small scale multifamily property for their own personal portfolios up and down the Wasatch Front here in Utah. the greater Salt Lake City market. And so I built up a pretty robust investor network of individuals that were interested in multifamily. And then a few years into that, realized, okay, I have a lot of these investors that I have conversations with, continuously, anywhere from 5 to 25 per month. I'm having conversations with active investors or would-be investors. And many of those investors actually didn't have any interest in buying that small apartment building, that sixplex, that 12plex, that 24plex, that fourplex. They just wanted the benefits of owning real estate. They liked the idea of multifamily, but they didn't really want to deal with all the hassles and challenges and frustrations of personal ownership and personal management. And so that's what caused me to go down this path of exploring the syndication model, understanding more about that, and ultimately helping my investors get involved in syndication deals where they could own a portion of a large commercial multifamily apartment building without all the headaches and hassles and challenges of personal ownership. So that's the synopsis of how I got into the space.
There's so much to unpack right there. I want to go back to your comments about being an agent or being in the residential brokerage side. So I've been in the brokerage side now on the ownership side, and seeing how the realtors and the brokers they move from one deal to the next, and so they get the rush of the closing check, and then they splurge for a little bit, and then they're off to the next deal. Then they splurge a little bit after that closing. So they're going for the emotions, the up and down, up and down. It's paycheck to paycheck, and it's so frustrating because the brokers and the agents, they are the ones that see the deals first. They're the ones that see the deals. They're selling them to the investor. The investors are making the money. The investors are the ones making the life change move by buying these properties. And then the broker and the realtor, they're broke at the end of the day.
Yeah, it's unfortunate that that's the case, but it's a reality for many agents. There is a shift in mindset that has to take place. I think for me personally, it was always, oh, I'll invest on the next deal. I'll buy the next deal. I'll buy the next deal, right? I'll broker this deal. I'll make a quick hit. The wonderful thing about being an agent and a broker is that you can create really a very comfortable, lucrative lifestyle that gives you a enormous amount of flexibility. And at the same time, you can become conditioned to just earning the next commission versus really, working and focusing on building wealth and cash flow where someday you have an exit. For me, my goal had been, I'm going to build up a sales team that would allow me to potentially exit to a certain degree. And then I would do the investing then, So there was a lot of excuses. And the reality is, there is a switch that has to be turned on or off where you start to look at investing first, brokering second.
That's good.
And if you look at it from that lens, then you start to look at the deal as, can I buy this?
Right.
Versus, can I broker this? Right. And once you flip that switch, then you're looking at it from a different lens and you'll take action accordingly. Whereas it's very challenging to go, I'm a broker first and, oh, maybe I'll buy a couple. Unfortunately, that model doesn't serve a lot of the agents and brokers that are out there. I think they fall into the trap of just always brokering and always earning the commission.
Yeah. So my story is flip-flopped in that I was an investor first, and I chose to get in the brokerage side because I felt the need to have a vertically integrated operation. So I wanted to have the entire investment operations in-house. That's the acquisitions, the management and disposition all together in-house as an investor. So that was my business case for getting into the brokerage and buying in the franchise.
Well, and in my opinion, that's a better path to go, right? Because you built the investor muscle first. Right. The brokerage business was just an ancillary business to help you be a little bit more efficient.
Exactly. Excellent. So let's keep going down this path of syndication. So there's people that are listening to this that don't even know what syndication is. So I guess, can you give the nuts and bolts for the new investor, most likely a realtor listening to this? So what's a syndication? What are some of the basic terms, and how does it work?
Yeah. Well, at a very high level, a syndication is simply a group investment. You're pooling investor funds together in a structure that allows you to go and buy a commercial, or really virtually any type of real estate. Syndication isn't even specific to real estate, but the term that we're talking about, syndicating equity. So we're basically pooling equity together to go buy an asset, a real estate asset. So in my case, as I was having these conversations with investors who thought the only path for them to invest in real estate was either to invest through a REIT or a crowdfunding platform, or buy their own single family or small multifamily property. Many of them were, high income earning, busy professionals. And they thought, well, I've just got to go buy this small apartment building. That's the only thing that they could really wrap their head around. Or this, single family home, or, look at short-term rentals or whatever. There's so many different strategies out there. The reality is, once we got into the conversation, they didn't want to own the real estate, or at least they didn't want the hassles and challenges of personal management. So that's when we started to explore what it was. And ultimately, syndication can be structured in a few different ways, but there's really the equity piece, and then there's the debt piece. So the equity piece is a group of investors pooling their money together, and then going and getting the financing for the remaining piece. Usually you're having to bring around 30 to 35% of the purchase price in the form of equity. Pooling investor funds in the form of, there's so many different ways that you could structure it, but you could have investors that are pooling $50,000 a piece, or $100,000 a piece, or a couple $1,000,000 a piece, whatever it might be. But you can structure those and then go get the debt for the remaining 65 to 70%, and then go buy, a large asset that you wouldn't be able to buy otherwise. So there's really a couple players involved in a real estate syndication. The first is the individuals known as the general partners, or they go by a few different terms, also known as the lead sponsors or the key principals. These are the individuals that usually one or a handful that are tasked with the job of going out and finding the deal. Negotiating the deal, putting the earnest money up front, doing the due diligence, analyzing the deal, going out and pooling the other investors together, going and getting the debt on the deal, and ultimately managing the deal from A to Z. Right? So those are the general sponsors, and it usually consists of a team, a small team, usually 2 to 5 to maybe 7 at the most, general partners that come together and are leading out on the syndication. Okay. And then you have, on the other side, you have the limited partners. These are the individuals, these are passive investors. These are the individuals that are basically putting in investing in a portion of the equity needed. So let's just use an example, a $10 million building. We're going to need roughly, let's call it, just for the simplicity, $3 million in equity. Well, maybe the general partners bring a portion of that equity, but they need an additional $2.5 million of equity that they don't have. They bring $500,000 to the table, and they need an additional 2.5. They can go out and structure a syndication. These deals are regulated by the SEC, so there's particular structures and there's particular rules about how they need to be handled. But they can go, and then once they have the appropriate structure in place, they can reach out to other investors and allow them to invest, in many cases, as little as $50,000 to own a piece of this asset that the team is buying together. So I'll stop there. That's just a very, very high level overview of what a syndication is and how they function.
Yeah, that's a great explanation. I just earlier this week, I had a phone call, a Zoom call with 2 of our top producing agents in our firm, and I explained that to them. and they've been in the business for 20, 30 years, and they've never heard of what you just said.
Yeah. Well, and that was me, a handful of years ago. When in the reality, as I was having these conversations with my investors who were like, man, is there any way that I can just partner with you and just, give you some money and allow you to go buy a building? And that's when I really started to explore this sort of passive investing concept. And I actually looked into helping my investors get involved in turnkey single family because that was sort of where my mind was, right? And that's something that a lot of investors can wrap their head around is investing maybe in, in deals that could provide a little bit better cash flow that's a little bit further away. But that really wasn't a model that I was excited about. And ultimately, it's surprising how few people actually are familiar with passive investing through real estate syndications and investment funds.
Yeah. And the example that I just gave earlier this week, I just gave the overview to these agents, and they were basically saying, here, I'm ready to write a check. Like, I don't even, they're at the point where they don't even want to look at the deal. They don't even want to see what type of property I'm buying. They just, I want to invest, and I don't want to think about it. I don't have to worry about it. So this is coming from a real estate professional that professionals that have been in the game for so long. They understand the value of having somebody else do all the hard work and do all the management and finding the property, selling the property, and they see the value.
Well, and even if the majority of the agents that are listening to this show were like me, like even though I've been in the real estate space, I didn't feel comfortable and confident to go and try to take down a commercial asset on my own.
That's a good point. Good point.
Right?
Yep.
So for me, that was a daunting task.
Yeah.
And most real estate agents and brokers aren't unlike other busy professionals.
Yeah.
They're just in the business of selling real estate. So they're really high income earning busy professionals who some of them will have the desire to go out and learn all the ins and outs of investing in these type of deals on their own. The vast majority of them would prefer to stay focused on their profession of selling real estate and earning a great income, and then deploying that income on large commercial multifamily assets completely passive and earning a great return.
And they are most likely extremely hyper local in their niche. They may be, making $20-30 million volume in just one neighborhood.
Right.
And so,
well, and that's actually a good point to just make real quick. One of the main reasons why I really like the syndication model is because in my brokerage business, which we still do, we still help buy and hold investors buy small scale multifamily property for their own personal portfolios. So just to use a quick example, here in my market, a typical fourplex is going to sell for anywhere between $800,000 to $1.2 million.
What market are you in?
In the Salt Lake City market, Salt Lake City, Utah. So we're talking about 4 units in one location, one asset, where they're going to get all the debt. They're having to sign on the loan. They're going to have to do all the management after the fact. And they're going to have to plop down, $250,000 to buy this one fourplex. Whereas, and in one market, right, in their backyard. Whereas they could potentially deploy that same $250,000 across 5 different commercial grade assets that are completely managed by someone else, that are in 5 different markets with 5 different quality operators, with 5 different business plans and 5 different asset classes. So talk about highly diversified investment of $250,000 that would have been deployed on one small 4-unit building where if they lose one tenant, they're only operating at 75%. Whereas, you lose 10 tenants on a 100-unit building, you're still 90% occupied. So anyways, that's the argument for syndication. The reality is that's not for everybody. There's so many of my investors who have zero interest in syndication. They absolutely want to buy their own property, be able to make all the decisions, fully control the deal. They don't have any problem with getting the debt They have the equity to bring to the table, and they can structure things in a way where they hire third-party management to manage the asset, and they can almost be completely passive, right? So it's not all just sunshine and roses. There are some drawbacks to investing in syndications, and the main one is control. So you're giving up control in return for the ability to be passive. Number two is that these are illiquid investments. This isn't like investing in the stock market or even in a REIT where you could invest today and pull your money back out tomorrow.
Right.
The reality is that these are usually 3 to 5 year, sometimes 7 to 10 year business plans where once you invest your money, you're in for the long haul. And ultimately, the sponsors or the general partners are the ones making the decision as to when you might sell the asset or potentially refinance the asset and recoup your investment. In addition, there are some restrictions on who can invest in real estate syndications. I won't go into great detail here, but typically you'll see syndications structured as 506B, as in boys syndications, or 506C syndications. 506B syndications, again, these are regulated by the SEC, so these are rules set by the SEC. So a 506B is a syndication which both accredited and non-accredited investors can participate in. An accredited investor is someone who has a net worth of at least $1 million outside of their primary residence, or they have earned at least $200,000 for the last 2 years and have an expectation of earning that same amount moving forward. There's also some other ways that someone can be deemed accredited, but those are the most typical criteria. So that's an accredited investor. With a 506B, both accredited and sophisticated investors can participate. The caveat is they need to have a pre-existing substantive relationship with one of the sponsors of the deal. So that's a 506B. A 506C is exclusive to accredited investors, and they must go through a third-party verification process. So if you're someone who maybe they have a bunch of equity sitting in their home, they focused on that, they've got $750,000 or even $1 million in their home, but they don't necessarily have a lot of other investments, well, they wouldn't necessarily qualify for the accredited investor status if they weren't earning at least $200,000 per year. It needs to be outside of their primary residence. But if they had a relationship with a sponsor that was doing one of these deals, then they may be able to invest in that deal, even if they aren't accredited. I hope that makes sense.
Yeah,
I'll stop
that's
there.
fantastic. That's a good explanations. Something that caught my attention before what you said regarding around making the decision to do passive or do a deal your own. My wife and I are in that boat right now. We just had an exit on a deal, and so we're looking at where to invest, and we want to invest in some passive syndication projects, and we will, and that's going to be the majority. But we said, hey, we want to still have some wholly owned real estate that we buy that we can have a home equity line of credit on in case there's an emergency. We can immediately take that money out on a home equity line of credit, whereas we will not have that opportunity in our syndication investments. And so that was a decision factor, saying, okay, we're going to put a certain percentage in a wholly owned and just keep it simple, a residential deal or something. Doesn't have to be high growth ROI, but just something simple so that we can have a quick emergency fund through a home equity line of credit. And that was our deciding factor between syndication and wholly owned.
Yeah, I have a lot of clients that are across the board. So some that have zero interest in owning their own real estate. They only want to invest passively. I have others that do a blend of both, like you, where they'll have a few of their own properties that are their own personal portfolio that they are fully responsible for, and then they'll also do some passive investing. And then I have, like I said, others that have zero interest in passive investing. They want full control and want to build up their own portfolio.
Yeah. I'm looking at some of your notes here. you're talking about a 5-point framework for finding the best syndication deals and sponsors. Can you talk about that and what you look for?
Yeah, so when I started getting into the space, I really had to ask myself the question, all right, who would I want to partner with on one of these deals? Now, keep in mind, my background had been in helping clients buy their own personal property for their own personal portfolio. And so the idea of getting involved in a larger syndication, have them passively invest with me, was something I took very, very serious, right? And I wanted to make sure that I was doing everything that I could on my end to make sure that we were successful on the deal that we're looking at. So first off, the most important thing, well, when you start investing in these larger commercial deals, there's a lot of metrics that are targeted, right? So population growth, job growth, inward influx of individuals moving into the location, migration. Sorry, that was the word I was looking for. Inward migration. And then you're also looking at rent rates and vacancy rates. And there's a lot of metrics that everybody's looking at when they're trying to decide if they'll buy an apartment building in a particular location. And all that is very important and should be taken into consideration. But for me, as I was investing outside of my local market, so the first deal that we did out as a syndication deal was in Kansas City, Missouri. I knew for me that I wanted to be in the Midwest. Utah, Salt Lake, my investors get to participate in a high growth market, right? But they don't necessarily have the benefit of a strong cash flow. And so I wanted to find a market that had a better blend of both cash flow and appreciation. And so I generally selected the Midwest market, and I had a handful of markets that I noticed had some population growth and job growth. So that's where I started. Then the most important thing for me in getting involved in a syndication was the sponsor. Who was the operating partner that I was going to partner with? That there's a few pieces that I wanted them to have. Number one, I wanted them to be local to the market that they were investing in.
Yeah, boots on the ground.
There's plenty of sponsors that are highly successful in investing. They're based out of New York and they're investing in Texas or all across the country. But for me, on my first deal specifically, I wanted to be partnering with an operator that was investing in their backyard. So that was number one for me. First and foremost is operator, and a subset of choosing an operator was number one, they needed to be in the market that they're in. They need to be living in the market that they're investing in. Number two, they needed to have a track record of success, meaning this wasn't their first deal. I didn't want to get on board with someone that was just working through their first deal, right? I wanted someone that had acquired roughly about 1,000 units under their belt and at least 3 acquisitions before I got involved with them. Okay, so that was number two, a track record of success. Number three was on a growth trajectory. What I wanted was I didn't necessarily want to partner with the individual that had already acquired $1 billion worth of multifamily and really was just enjoying what they had built over the last 10 years, because my investors want deal flow, right? They want to be able to invest in these deals. So I needed to partner with someone that would have deal flow. And so I needed someone that had a track record of success, but was also on a growth trajectory. They were really trying to build out their company. They would be hungry and excited to do more deals. Number four was that they needed to be values aligned with me, meaning the way that they would treat their investors is the same way that I would want my investors treated. They operate with a high level of integrity and ethics, and they're ultimately going to be people that I feel like will do the right thing regardless of the circumstance. So that was number four. And number five was I needed to like them. These were going to be these individuals, whoever I partnered with, were going to be my partners for the next 3 to 10 years on this project, right? So I needed to like these individuals. The challenge with that 5-point framework is that it takes time. It's not easy, especially as a passive investor, to just, go and be able to vet a sponsor at that level. So that was part of the value that I was bringing to my investor network, is that I was doing a lot of the heavy lifting on vetting a lot of different sponsors that were matching the criteria that I was looking for. That is just the top of the process of evaluating a deal. After the sponsor, then it comes down to the deal itself, the structure of the deal, the business plan, et cetera, et cetera.
Excellent. Can you talk about co-sponsoring? I think that's kind of where you're heading. It sounds like you have your investors that you help place into other operators and other syndication opportunities that necessarily you're not operating.
Yeah, well, there haven't been any deals where I'm not the general partner. So
Okay.
so what you're alluding to is that my investors would come into a deal through me. That is true. On all the deals that I've done, I'm a general partner. I'm a what they would call a co-GP. I'm
Got
not
it.
necessarily the individual leading out and sourcing the deal at the very front end of things. So, for example, my partners in Kansas City, they were the ones that sourced the deal. I had been in contact with them long before. We had built a
Got it.
relationship.
Got it.
I told my partner, I said, "Hey, look, I think my investors have an appetite for getting involved and investing in a deal in Kansas City. So let's keep your eye on, maybe one of these next deals. Let me take a look at it and let's see if it's something I'd be interested in." So he had a deal come around the corner that he sent to me after it was under an LOI, a letter of an intent, just prior to a contract, right? So in the commercial world, you often submit a letter of intent, just for the residential agents out there, letter of intent. And this agreement is non-binding, but sets out the general terms of what the purchase contract might look like. Once they had that letter of intent, they sent it to me. I had a chance to look it over, become familiar with the deal. I liked the deal. I felt like it was one that we could get involved with. That's when we put together a formal partnership, put together our agreement of how we were going to operate that partnership. And then my investors were able, because it was a 506B syndication, my investors wouldn't have been able to invest in my partner in this deal with just my partner.
Right.
They came through me. I was the conduit for them to be able to participate in
Got
this
it.
deal. And then just me, myself, and my partners and their team were the individuals involved in the deal. We raised all the equity. We operate the deal. Obviously, with them being boots on the ground, they're doing the heavy lifting on the asset management side. But I'm involved in that process with them, on calls with them, discussing the asset management, how things are going, making high-level decisions about the construction process, the asset management, and different initiatives that we're trying to accomplish to get the deal performing at the level that it should.
Excellent. Yeah. Thanks for explaining that. So, what's in store for David? You've achieved a lot in your career, and talking about growth, and you wanted to partner with co-GPs that are experiencing growth. So, what's growth look like for your business?
Yeah, more of the same. So we have our brokerage business here locally in Utah. We're going to continue to help private investors buy property for their own personal portfolios, and we're going to continue to syndicate deals with quality sponsors all across the country. So to date, we've done about $170 million in syndication deals. And I've had a lot of my investors be able to participate in those type of deals, diversify their investments, in addition to what they're already doing here locally, being able to participate in those deals and work on those projects. So we'll continue to do more of that. Syndication deals in other strong markets across the country, and brokerage business here locally.
Fantastic. Well, I really appreciate you coming on the show and breaking down the syndication, which to many of our listeners, this is something new, and just to people like you and maybe to me, it's something that we've been doing for the last 5-10 years, but that's okay. It's good talking about just the basics once again. So really appreciate you on the show. So I guess tell the listeners, where can people find you?
Yeah, the best place to go, you could go to, if you're wanting to get an overview of the syndication process and the syndication model, we do have a free guide on our website. It's a passive investor's guide to real estate syndications. They can go and download that from the website. That is canovocapital.com. That's Canovo capital.com, canovocapital.com. And then they can also check out our podcast, the Lead Sponsor Podcast. We interview sponsors who have acquired roughly a minimum of $50 million worth of multifamily, self-storage, mobile home park real estate. And we talk about their businesses, how they've grown, some of the strategies and tactics that they use in their business, and share them with all of our listeners. So that's the Lead Sponsor Podcast.
Excellent. Well, thank you so much, David. And I guess that's a wrap for this episode of Wealth Building Strategies Podcast. Thank you.
Thank you.